Hi guys, and welcome to today's session. If you've not been to one of these sessions before, it's my absolute favorite session that we run week in, week out, and it's all about strategy development. Now, we take a look at usually somebody who's in the audience, we take a look at their track record, their Darwin, and we try and analyze what's going well, what could be improved on, and anything that I can kind of notice from a statistical perspective. Now, I've been a trader for 6.5 years, and before that, I was a data analyst. So this is kind of combining two of my favorite things in the world, which is big data sets, trying to find patterns in, weird data, looking at unusual variables that you might not look at on a daily basis, and trying to pick them apart to see if there's any area for improvement. Combining that with trading, it's just, yeah, that's why I love these sessions so much. But I actually wanted to start this session today with just a minute of this clip from Anton Creel. One of my friends sent me this earlier when we was mid-conversation, and I thought it was relevant to some of the stuff that we tend to talk about in these sessions. So for the guys who are watching this maybe not for the first time, because we have people coming back to these sessions week in, week out, or if you're watching it in a recording, you'll know that I always talk about the relationship between your personal life and your trading, and how you can get certain skew on some metrics. For example, your performance on certain days of the week might be skewed because on certain days you might have work or relationship commitments, you might have children. There might be so many different things that affect you from like I say, the unusual variable perspective. Not every day is the same, not every hour of the day is the same, and so on and so forth. So I just wanted to share this clip just before we get in, and then we'll do the usual. I'll bring up a Darwin. If somebody's in the audience and wants me to take a look at their Darwin for the session, I'm more than happy to do that. The only thing that I ask is that you have a minimum track record, ideally of 6 months, unless you have an extensive track record with less time but more trades. So let's say you have a 3-month track record, but you have at least 300 trades, for example. At least then I've got enough data to go on. But I'm just going to play this clip just for 30 to 40 seconds or so. Really try and listen to what Anton, if you don't know who Anton Creel is, he's an ex-hedge fund manager, just a super knowledgeable guy when it comes to anything trading, anything investing. And he's definitely somebody that everybody should know and listen to. So just listen to what he's saying here and try and understand the power of his words.
If you think about it like this, if your personal life is really hectic or your business life is really hectic all the time, it's going to affect your trading decisions. And vice versa, actually. If you have an extremely complicated, very hectic trading lifestyle, then it's going to affect your personal life. So your personal life, your trading life need to mirror each other. And decision fatigue is a big thing in the industry that you need to avoid, because it creates scenarios where you can make bad decisions and it can cost a lot of money. So every professional trader knows that you have to absolutely have a personal life that's simple and a trading life that mirrors your personal life, and vice versa. And you look at all these guys, the mentors.
So I'm just going to pause it. I hope you could hear the audio. I should have probably checked at the beginning of the clip whether you guys could actually hear. But I think you did. It was coming up saying there was sound going through. So fingers crossed there. But I think that's something that so many people overlook. And the reason that so many people overlook it is because you log into social media, or you'll read a book and you'll see so many success stories about so many traders. Whether they're legit or not, that's a conversation for a different day. But you might log onto X and see this trader's using this strategy, this trader's doing this trader's doing that. But what you fail to recognize is every single trader that you're looking at, or looking up to in this case, has a different lifestyle. They have a different risk profile. They have a different personality. And therefore, just because that one trader has found success with a certain strategy or a certain methodology, does not necessarily mean that you will also find success using that same strategy. You know, you have things, like I say, such as routines, such as commitments, responsibilities, emotional control. Like, I would never personally be able to be a scalper. I just don't have the emotional capacity for that. I don't like things that move so quick. I like to sit back and let my trades play out naturally. And it's about knowing that. It's about knowing yourself as a person, and therefore knowing yourself as a trader, and building your system to fit that persona, not the other way around. You don't want to build your persona as a trader and try and implement that onto the market or onto a specific strategy, because they're sometimes just not compatible. And like I say, the reason I shared this little clip was because it summed up perfectly what I talk about when we go through a lot of the statistics that we actually go through when we're talking about things such as the ideal trading sessions, or your expected value per day of the week. All of these different variables or measurements that we kind of look through on a weekly basis were summed up perfectly by Anton here. And I think everybody should take a step back, you know, run this little exercise, whether it's on a weekly, monthly, daily, yearly, however frequently you want to do. You take a little step back from your trading, and you just look at yourself and go, okay, well, how is my life right now? What do I do on a daily basis? How much can I give to the market? And therefore, what should my approach be? Because every single person should have a different approach, or a unique approach. Anyway, we'll get on with the session now. The great thing about these sessions is I tend to run them a little bit more relaxed. So I love going over like clips, charts, people's Darwins and strategies and stuff. Patrick, good to see you, dude. It's been a while. How are you, man? Yeah, Patrick said good points. Yeah, I mean, anytime you're talking about an Anton Creel clip, it's always gonna be a good point. But I do think this is specifically relevant to the traders that we have, because we house a lot of traders who are, they have some success, they have the knowledge, but they're still finding their feet as a trader, trying to become a professional. Um, and I think it's really important, and it's something that I've been really diving into myself recently, is what does your trading look like a year from now, 5 years from now, 20 years from now? How does that look? I know you can't always see that far into the future, but you have to framework what is it going to look like, not just going, well, today I'm going to trade based on a moving average set. Okay, so how is that going to scale going into the next year? How are you going to approach that? What times are you going to be looking at the market? How are you going to approach it? So there's all these different questions that you have to ask yourself outside of looking at the charts, or outside of reading a news squawk and, you know, making a decision to jump into a trade. There's so many variables that go into a trading system or a trader that often people overlook. And that's really what I'm trying to dial into in these sessions, is that you don't necessarily have to fix your issues on the chart. It might not be a new indicator. It might not be a new price action pattern that you have to find or change or follow. It can just be as simple as identifying flaws within yourself as a trader, in terms of, I don't suit this style of trading, or my expected value is less here, and therefore I need to pull back there. However, my expected value is higher over here, maybe on this asset during this time frame, on this day of the week, and therefore I'm going to push down here. A great example of this, in fact, I'll bring it up right now. I recorded a video that should be going live within the next couple of weeks on THA, which, if you don't know, is our most capitalized trader at Darwinex. Currently managing 20 million. I think is it $23 million? So yeah, so the THA, which is run by a team called Thales in Finland, currently managing $23.5 million. Now, it looks fantastic on the face of it, right? Every year is a green year, like they're doing really well, managing 23.5 million, track record, fantastic. Now, what's interesting is I was taking a look at their statistics. So I was recording a video on the trader, because I know Atu, the trader behind it. I know how they trade to a degree. And so I built a video about what a 23.5 million funded trader would do. Now, what was really interesting is the return distribution by day of the week. Now, again, if you come to these sessions on a weekly basis, you know I always say, if there's a pattern, don't ignore it. You always have to monitor it. Even if it's not showing any warning signs or red flags in that moment, you absolutely have to monitor these patterns early on, so that you can nip it in the bud if something's going wrong. Now, let's scroll down. Now, take a look at this chart. I'm going to zoom in slightly. Take a look at this chart, return distribution by day of the week. Now, I'll just summarize for the guys who haven't seen this chart before. What this shows is there's a number in these boxes here. So this shows how many days that this trader has taken a position on the specific day of the week. So you can see Monday, they've taken 107 trades, Tuesday 207, Wednesday 299, Thursday 311, and Friday 271. Now, apart from Monday and maybe Tuesday slightly lower, but between Wednesday, Thursday, Friday, and I would argue Tuesday as well, there's not too much discrepancy. There's no clear outlier apart from Monday, which is a lot lower in frequency than the rest of the days. Now, when we look at their distribution, which is the chart, which shows how much return has come by day of the week, so split down by these Mondays, Tuesdays, Wednesdays, Thursdays, Fridays, what do you initially notice when looking at this chart? And I'll give you a second. I'll hover over. In fact, I don't even need to hover over it right now. Now, I hope when you're looking at that chart, the first thing that comes to your mind is that this trader, no matter how fantastic they are, which they really are, believe me, no matter how fantastic they are, they clearly have a different expected value on a Thursday than they do on a Monday. Now, remember, this isn't a 6-month-long track record. This is a 10-plus year track record. Okay, so this was started in 2015. So this track record's been running over 10 years. And yet, they haven't made money on a Monday, period. They're actually down almost 9%. If you chopped all of their trading activity from a Tuesday through Friday, they would be a losing trader on the face of it. You never know if some of these trades are hedges, what have you, but we'll leave that for now. We're just looking at the data from a very, bird's eye view perspective. But they haven't made money on a Monday at all, ever. You can pretty much see they went straight into drawdown back in 2015 on a Monday, and the figure has never, ever been green. So they've never made a positive return on a Monday, which to me would mean they have a negative expected value on their trading system on a Monday. However, when you look at Thursday, it's complete other side of the ocean. They've done a 226.29% return on a Thursday alone. Now, of course, their return is higher on their Darwin because it's compounded over the 10 years. But if you just took their trading activity from a Thursday, it would equate to 226.29%. Completely different kettle of fish when we're comparing Mondays to Thursdays. Now, going back to the reason I'm talking about this is because going back to Anton's point, which it's kind of a little bit different to what Anton was talking about, really. But it's about knowing yourself, knowing your routine, knowing where you perform and where you don't perform. This guy is the top performing trader in Darwinex, period, yet is a losing trader on a Monday. Let that sink in. Now, all you have to do as a trader is find out where you perform well and where you don't perform well. You put your foot down where you know your expected value is higher, and you take your foot off the gas where you know your expected value is lower. Now, I could give you a million reasons as to why ATU or THA's performance is better on a Thursday than it is on a Monday, but we don't truly know. The only thing that I can put it down to is I know THA is primarily a news trading system. They will wait for a news release to drop, and then they would take a position after the economic data comes out. Now, we know that Thursdays is kind of data heavy from a US perspective, or Wednesdays even, but Mondays generally is fairly quiet from a data perspective. You've also got Fridays, which is notorious for things like NFP and stuff, but generally what we see is Thursday is fairly active from a US perspective. So we do have that caveat when we're looking at this, where we go, okay, well, their biggest moves are probably made on a Thursday, which we can clearly see. It's the only triple digit returning day over a 10-year period. But going back to my original point, which is what I really want to nail down here, is that you have to, as a trader, find your expected value. And you might be thinking, what on earth is my expected value? How do I find that? What do I look for? Which is the whole point of these sessions, right? is that we look at different variables that would define your expected value as a trader on a trade by trade basis. Now, I do it by combining separate variables, taking a look, combining them together and going, well, this is an asset where I generally perform higher during a period of the day when my performance is generally higher, on a day of the week where my performance is generally higher, and therefore my expected value is higher than if it was the complete opposite, where, for example, if I bring up one of my automated strategies, it's recently gone live last month, because I know there's an expected value differential here. So this is one of my, this is a portfolio of strategies that I run, all automated, scaled up heavily. I'm only up like 2% at Signal account, so in a month and a half. So this is scaled up quite heavily. But if we take a look at assets, we take a look at indices, right? So this is basically just NASDAQ, and which is very infrequent because the NASDAQ trades are usually higher time frame. So we're looking primarily at WS30, which is the Dow Jones, compared to gold. Okay, those are the two assets that I really want to bring your attention to. So if we look at indices, it's got 49 trades, which is 54% of the trading activity, compared to gold, which is 34 trades and 37% of the trading activity. So it has been more active on trading the Dow than it has in gold over the past month and a half. Now, if we take a look at the win rate just as a base metric, you can see the strategies won 30% of the time. Not great, right? I know you can make it profitable, and it is over an extended period of time, but just during the time it's been live, 30%. Now, gold, 52.94%. So already I'm starting to notice that commodity or trading gold, I take less risk exposure because I'm trading less, but I have a higher win rate. Okay, now we look at the return. So with the low win rate, the high trades, it's actually providing me with a negative return. So I'm taking more risk exposure, trading a lower probability strategy, and generated a negative return. Whereas gold, I've taken less trades with a higher win rate, and I've had a much, much, much higher return. A disparity of, what's that, 11.5, add another 1 point, so 12. Over 13% differential between the return on gold and the return on WS30. Does that mean I should stop trading the Dow and focus only on gold? At this point, no, because this is only a month long. And if you was here at the start of the session, you'll know when I'm making justified decisions on or giving somebody advice, I always say you need at least 6 months worth of data to even be able to feasibly say, yes, this is a change that we should implement. So there's nothing to worry about here. It could be that the strategy is going through a rough patch, the one that trades the Dow, which it is. I know that that strategy has a max consecutive loss of like 22 trades in a row, hence why I trade them all with low risk at master level anyway. So I know that can be the case. I know that it can lose a lot of trades in a row. However, as of right now, is the expected value between the two strategies the same? Absolutely no way. No way. I've got gold where I'm trading less, making more, and have a higher win rate. Whereas I have the Dow where I'm taking more trades, making less return, a much less return, and I'm losing more trades than I win, and losing more trades than I do in gold. And therefore, welcome, Rob. Rob's just popped into the Discord chat. Had to spend my profits, but got paid the other day, £400 equivalent from SPWL, man. Love that, dude. I've been rooting for you since day one. Super, super proud of you. Congratulations, man. I'm really glad that you've got to that point and that you've taken a payout from Darwinex Zero. Big up to you, man. Like, really. And so, yeah, so this is just a base metric that I take a look at to determine at asset level what's my expected value. And the reason that I do this is, and for everybody else as well, same with THA, the same with me, the same with most people. If you're trading the same system across multiple assets, it will never perform the same on every single asset. And the reason being is every asset has different key speakers. It has a different economies backing it, or different reasons, like to back a certain commodity. For example, a commodity is never going to move the same as US equity would, or the same as a currency would, because they all have different reasons of existence as an asset class, right? And so if you're implementing the same strategy from one Rob said I'm very laggy. Can anybody else confirm whether I'm lagging or whether the stream's okay? I can see OME.L has messaged me as well about taking a look at their Darwin. All good. Rob, maybe it's worth leaving and rejoining. As long as you can all hear me, I'm sure Rob can leave and rejoin. Sometimes Discord plays funny games like that. So yeah, enough about expected value. We've had OME-L or _L has DM'd me on Discord asking me to take a look at their strategy, so I will do that now. OBIE. Okay, cool. Oh, I like that color. What is it that color for? I've never seen this color. Maybe it's because it's a futures count. I thought they was all the same color. Let me check that. SUZ. Oh, no way. I wonder if that's been a recent update, because I've never seen those colors before on D0. Strange. Anyway, that's besides the point. Let's take a look at how long your record is. Okay, so it's like 2.5 months. It's going to be difficult to, well, probably even less than that. It's probably 2 months. It's going to be difficult to get any real takeaways from this, just because of the length of record. If we just take a look at how many trades you've taken. Oh, okay. I presume this is an EA or a robot, purely based on the trade frequency. So almost 12 trades a day. I see you typing. Just confirm whether it's a. Okay, so it is you, dude. Are you a scalper? Are you a scalper, or well, you're clearly not a scalper because you're holding trades for a long time. Are you just pyramiding into positions? And I said, Rob, I said, congratulations to you, dude. I was like, I've been rooting for you since day one, and I'm really, really, really happy for you. And I'm happy to see that you've taken a payment and that you've got proof of concept. Super, super proud of you. Okay, so that would make sense. If you're kind of pyramiding into trades, that would make sense why your trade frequency is so high. But your losing and winning trade durations are so long. Now, again, like I say, we're probably going to struggle to take any real key takeaways from this just because of the lack of length. What I mean by that is you're very restricted by the time of your track record because market conditions haven't changed really within a 2-month period. They might adapt slowly, but it's like you wouldn't know if this strategy was working back in Brexit or, through the Trump inauguration, all those sorts of things. So just with that will come kind of a disclaimer that anything that I say is kind of things to potentially explore or to keep an eye on. And just make sure that you're aware of them going forward. So first things first, you got 30K under management. Congratulations to you, dude. I presume you got that on your second. It would have been your first full month trading, right, in May. So congratulations to you. 7.92% return. Max drawdown of 2.52. That's absolutely solid. Great risk exposure to generate that return. Try and protect this within an inch of your life. Of course, you're probably going to go over a max drawdown of 2.52%. It's natural, but just try and minimize as much drawdown as you possibly can. Lino, welcome. Lino says, still on calibration phase. Looking forward to getting funded. It's going to be a long road, dude, to let me reword that. It's going to be a long road to get into investor capital. You're going to have to put in a serious amount of work, building your record, staying consistent, trading the best way that you know how. But, we have a lot of funding to give to our traders for the ones that stick it out and have consistency over a long period of time. So I'm looking forward to seeing your journey, dude. Keep me up to date how you get on and attend these sessions on a regular basis. And I'm sure in a couple of months we can be doing this for you, taking a look at your Darwin. So Sharp ratio is a little bit skewed at the moment. A Sharp ratio of 5.24 is like incredible. And this strategy would be worth millions to a hedge fund or an investment bank. So this will come down over time. Don't be concerned. It's just whilst you have a lack of data, some of these metrics can be skewed. For example, I had a strategy that once that I ran it. I was trading manually for 8 months, and I didn't go over a 2% drawdown, and I generated like 11% return, and my Sharp ratio was insane. And then I went on like a 10% drawdown then, and my Sharp ratio got obliterated. So don't read too much into these statistics right now because we haven't got enough data to give you an accurate read. All-time high quote 108.01, which was today, and you're slightly down from all-time high quote, but I wouldn't really call it an all-time high quote. You're just gradually making the new high. Let's take a look at what you trade. Index futures, commodity futures, FX futures. So you trade quite a bit. So you trade in all the FX majors. 6S. What's 6S? Is it? It's yeah. Swissy is the one futures contract I refuse to trade on FX majors. Then we have Bitcoin, silver, gold, ES, DAX, Dow, and NQ. So you have quite a range of assets. Now, I'm just going to filter it because you have so many. I'm going to take a look by family of assets first. So indices, commodities, FX, and crypto. Crypto doesn't show a thing. Interesting. Yeah, so indices, 301 trades, 55.81% win rate with an approximate return of 7.18. So this is fantastic. Nothing to be concerned about there. Your majority of your trading is done on the NQ. Small amount on the others. Not enough data to really look at, but nothing really to be concerned about there. I always say there's two sides of the fence. Again, guys who come to these sessions on a regular basis will know this saying off like the back of their hand. You have two sides to the fence of building a strategy. You have the one side, which is where you're trying to increase your win rate. And I always say everybody should try and aim for a plus 50% win rate. I know it's not possible. It's not possible for everybody. It's not possible for every strategy. But everyone should try and increase their win rate as much as possible. You're optimizing the system. You're taking a look at where can you generate the best trading ideas. Then the second side of the fence is how to optimize the system on a trade by trade basis, i.e. looking at all your historic trades. How far did they run from a perspective of your maximum excursions, i.e. your maximum adverse excursion, your maximum favorable excursion? How can you take more from each individual trade? And that's where you start fine tuning. Nobody should get to fine tuning their trades on a granular basis until they've finished with the left side, which is trying to generate the best trading ideas possible. Best way to do that is by trying to get your win rate up. I can see that we've got a question from Patrick. Kieran, do you have some statistics about the average drawdown from the top 5% of Darwin Gold and Silver? Would be nice to know as guidance. Off the top of my head, I don't have anything, but I'm sure I could probably find that. The only difficult thing with that is the top 5% I mean, gold's a little bit different, but the top 5% of traders will generally change on a day-by-day basis. I guess the only thing that you could do is just go to the leaderboard and kind of get an eye for it. I will check to see if we have a report sort of on the back end where I can pull this data. It's not even going to show you, is it? And it only shows you for 6 months. Yeah, leave it with me, dude, and I'll see if I can find a report on that or something that shows. Because off the top of my head, I don't think I have anything, but some of the team might do. So Omi has asked, do I have to take a trade a day to get my next allocation? Because it says how much I can make on the day, but the other days I'm not trading. It's not saying I'm making money, even though I'm trending. How does this work? I'm not 100% sure I understand that question. You don't have to take a trade every single day to get your next allocation, because it says how much I can make on the day, but the other days I'm not trading. It's not saying I'm making money. I presume by that you mean if you're in a position and it's trending and it's going in your favor, it's not showing how much money you're making. I'm presuming that's what you're saying, but that would just be a case of it would take a while for the dashboard to update. I would presume is the answer to that question. But if I've kind of misunderstood that, please let me know and I'll re-answer you. Taking a look at commodities again, plus 50% strike rate, so fantastic there. Generating a little bit less of a return, which is kind of standard. You have less trade, so you would expect that anyway. But maybe that's a slight deviation in your expected value. Clearly, you trade indices very, very well, and maybe monitor this, because if we 3x your record length, so let's say we get to 9 months, and all of this stays the same, so that follows the same patterns. So let's say you've done 900 trades on indices, keep win rates the same, and you've done 21% return on indices. But then on commodities, you've done 450 trades and only generated 1.5%. There's clearly a different expected value from your strategy trading commodities to trading indices. Now, when it comes to things like that, something that I love to do, and again, the guys who come to these sessions all the time will know I recommend this to everybody week in, week out, is implementing a risk barometer, where we measure our expected value based on these different variables, and we allocate risk dependent on the grading of that trade. So not just by looking at a chart and going, well, I'm grading this as an A+ setup because I fancy the level. It's nothing to do with that. We're looking at your data, what has worked over the past X amount of months/years, grading it specifically based on those variables, and then increasing the risk slightly and decreasing the risk slightly where your expected value is higher or lower. Now, I'm not talking about doubling, tripling, quadrupling your risk, but what I'm saying is when you're running hot and your expected value is higher, push your risk slightly, maybe by 0.1, 0.2, 0.5%. So the way I do it is implementing a risk barometer, having a base value of 1. 1 doesn't necessarily mean, see you later, Patrick. Pleasure to have you, dude. 1 doesn't necessarily mean 1%. It can mean 2%, 0.5%. It can be whatever you want it to be, but the baseline is 1. When you have a trade that is of higher expected value, you can run your risk barometer up to 1.1, 2, 3, 4, however much you feel based on the expected value of that position. When your expected value is lower, i.e. you're trading an asset where you generally don't make as much money on a day that you generally underperform, your expected value might be lower. So instead of risking the full baseline of 1, which again could be 0.5%, 0.75%, 10% for all I care, you slightly drop that risk down. So maybe you cut the risk by 0.10% or 0.2%. So instead of risking a full 1% on the trade, you just risk 0.8% on the trade because you have a lower expected value. Not everybody agrees with me on that concept, by the way. I'm not saying what I'm saying is correct, and what I'm saying is everybody should do it, but it's a common theme amongst top traders, top professional traders. Lance Breitstein talks about it a lot, where he talks about grading your setups based on different variables and pushing more size when the grading is higher, essentially. So it's not something that I've picked out of thin air. A lot of the pros do it, and I think retail traders would make a lot more money if they also knew when to put their foot down on the gas and actually followed through with it too. So we're seeing another slight discrepancy here. Again, too early to tell anything real, like real, that needs changing right now, but maybe something to monitor is, again, there's a slight dip in the expected value based on trading FX. So when you're trading FX futures, again, there's less trades. You've got a lower than 50% win rate. So your win rate's dropped by 10% here from your average, almost 10%, I should say, and you've actually got a negative return. So again, just keeping an eye on this. I'm not saying to drop trading FX by all means. I wouldn't say that until you've got 6 months data at least, unless you're using FX as a hedging mechanism. For example, when you go long the indices, you might be going long a specific currency to kind of hedge against yourself. And unless you're using it for that sort of mechanism, it might be worth scaling back the trading on a certain asset. I always say every trade that you take will increase your exposure to the market, therefore increasing your value at risk, therefore reducing your risk multiplier. Now, let's say your FX trades were down 2%, just because it's a little bit more dramatic. Let's say it was down 2%. If you hadn't have taken those trades, and I know this is all in hindsight, but if you hadn't have taken these trades on FX, you would have saved 2% of P&L. So your record would be 2% higher. But actually, it would be more, because if you hadn't have taken those 72 trades, you wouldn't have taken the risk exposure on those positions, therefore lowering your average deleverage, therefore potentially lowering your value at risk, therefore potentially increasing your risk multiplier, or allowing you to kind of save the exposure there and spend the exposure on your gold trades or your indices trades, and therefore making more percentage there. So it doesn't just save you from the losses, cutting dead assets. It can also increase your exposure on your winning positions. So that's important to bear in mind. Now, again, I would want to see significant data before you stop trading a specific asset. For example, I would want to see that you was hemorrhaging money consistently over time. 0.2% isn't enough to be kind of concerned. Neither's a 47% win rate. However, if that continues for an extended period of time, let's say 6 months, 9 months, 12 months, I would start to go, maybe I need to start making a change here, because clearly something's not working as well as it does when I trade the NQ. Ohm said, that makes sense since I was attempting to do it, but the percentage didn't make sense as a positional swing trader because I would need to hold over 2 to 3 months. So glad you saw that and I jumped out. I'm presuming that didn't make sense as a positional swing trader because I need to hold. I'm lost to what I was even talking about, to be honest. So glad you saw that. I'm wondering what I saw about the expected value of the assets, I'm presuming, to cut down the percentage. Okay. Yeah, to cut down the percentage on the and lose on the 72. Yeah. I mean, the thing is, right, you can do this yourself, right? And this goes for everybody. You can analyze your own statistics and try and do it with an unbiased perspective, because usually you will be able to find flaws, or not necessarily flaws, but things that can be improved or things that are going well. You can find it. But when you're looking through a biased perspective, for example, if I said you should stop trading FX, but you go, I've been trading FX for 10 years, I love trading euro dollar, it's hard because you're emotionally attached to your trading strategy. Whereas somebody looking at just your data and your statistics and these variables, it's very easy for me to just say with conviction, you shouldn't be doing that. Doesn't make sense. I'm just going to check. I just realized, just going to check to make sure we've got no comments on Instagram and YouTube. Had a couple on Instagram, but they were random. Okay, let's get back to it. Trading time distribution. This is looking at your activity based on time of day, or at least trading sessions. So you can see you're clearly more active in the European session, which reflects in the return generated. Now, I should caveat this with the number of trades. This shows an opening and closing of a position. So it doesn't necessarily mean that you've taken 517 trades. You should always cut these numbers basically in half, because that's the amount of trading decisions. But there's nothing to really report on this, to be completely honest. It looks in line with how it should, which is the only thing that I generally look for when I'm looking at this metric. Is the more trades you take, the more return you should make. Otherwise, you should just stop trading throughout that trading session. But the higher your trade number goes, or trading decisions go, the higher your return goes. So there's literally nothing to worry about. The only thing I would say, unless this is you're setting stop loss and take profits, and that's when your trades are being closed, you're pretty much active all hours of the day. All I would say is just take care of your health. Make sure you're not staying up 24 hours a day to trade. But, I am aware that this could just be your system hitting targets or hitting stops, for example, and therefore closing you out of the positions. Now, your return distribution by day of the week. it's been 9 weeks, so it's very, very difficult to take anything real from this metric right now. But again, it's all about identifying the patterns early. Now, yours is quite clustered. You're positive on all of them, and you're quite clustered. So there's not really much differentiation, or sorry, there's not much differential between the return by day of the week. Your Monday's the highest grossing day with 3.07%, and your Wednesday is your worst performing day with 0.25%. However, with the length of the record, that's not enough to kind of make any assumptions based on, because if we take a look at the Wednesday, you go on the face of it, Wednesday's your best day. Sorry, Monday's your best day, but Monday's was a losing day until you had this absolutely massive day here. So I wouldn't read too much into this yet. I'd like to see kind of the days spread out a little bit more before you start making decisions. This goes down to two things, in my opinion. You have the one, which is the strategy side of things. Sometimes your strategy will perform better on certain days and perform worse on certain days. The examples I always give is if you're following a trend following strategy, you can do this research for yourself, but from the research I've done, generally, if you've got if you're using a trend following system and you're looking for a bullish week, your low of the week will generally be made on a Monday and your high of the week will generally be made on a Friday. Of course, not every week, but that's the highest percentage chance over the past 5 years of that happening on a certain asset from my own research. Now, if you're trying to trade a mean reversion strategy and fading that trend, for example, you're trying to get short on, I don't know, a Wednesday or a Thursday, when you know that it's likely to cause a high of the week on the Friday, you're kind of setting yourself up for failure, and vice versa. If you know on a specific asset that you're trading, and bear in mind, guys, you should all know this. You should all have done this sort of research into your assets that you trade. If you're trading gold, for example, and you know that the highest chance of making a high of the week is on a Wednesday, and you're trying to trade a trend following continuation against that statistic on a Wednesday, let's say you're trying to get long, knowing that Wednesday usually forms a high of the week, again, you're setting yourself up for failure. However, all to go back to the point is that dependent on the strategy that you're trading, generally it will perform better at certain times of the week. Again, Fridays, generally most institutional players are going to be logging off for the week, and if they're not holding positions over the weekend, if they're not like a huge investment bank who's holding for months, let's say it's an intraday trader who's managing a significant amount of capital, they might have to close out their positions at the end of every week just to nullify any weekend risk. So, waking up on a Monday morning, checking into their desk and seeing that the market's gapped against them or gone limit down, for example. And therefore, what you'll see is a heavy outflow of the market on a Friday. Volume will drop, and therefore, if you've got an algorithm that's still trading on a Friday the same way as it would midweek when the market's way more liquid, again, you might find that Friday generally underperforms, all because the context of the market is different at that moment in time. Again, this is just another variable to think about. There's nothing that's actionable from this right now, but I'm just trying to throw things your way that you could look at and go, well, actually, that's interesting. I'd never thought about that before. I've worked with a lot of traders over the past few years, especially since being at Darwinex. And one of the things that I've noticed, which is a general rule of thumb with every single trader that I work, not every single trader, but 99% of traders that I've worked with, they're all obsessed with technical variables and they ignore everything else. They will look at a chart, that is their be all and end all, and that's fair enough. I am myself very technical heavy, and building an edge around technical variables is fairly easy to do so because you look for a pattern, you find how that pattern repeats, how it acts at certain times of day, days of the week, certain levels, and then you execute based on that. But there's so much going on behind that chart that you're not even thinking about. You're ignoring 1,000 variables to focus on one. The whole point of this session is highlighting new variables that you can incorporate into your system. So, for example, if you're looking at a level, let's say you're THA, right? Let's just pull it back to THA for a second. It's a good job I didn't have any dodgy things up on my computer then. Let's say you might not have seen that actually. I clicked something on my mouse and it pulled up all my windows onto my screen, but obviously I'm screen sharing, so it's a good job I wasn't watching anything dodgy. Let's say we're THA, right? I forgot where I was going with this. Oh yeah. Okay. So we're talking about variables, right? So a variable that stuck out to me within 2 minutes of researching this strategy, and again, who am I? I'm not telling THA what to do. They're managing more money than me. They're far more successful trader than me. But again, going back to my point, what I said earlier, it's very easy to look at your own trading through kind of rose-tinted glasses, have a very romanticized view about who you are and what you do, and be very reluctant to change. I looked at this and sort of straight away said to myself, "There's absolutely no way you should still be trading on a Monday. Sorry, Monday. It doesn't make sense. Your edge clearly isn't there on a Monday." And I don't say this to be demeaning at all. And I have a good relationship with Atu as well, and I would never say anything to offend somebody. But for me personally, I would be looking at this saying I just wouldn't make any money. Like if I traded this the same way for the next 10 years, I would expect Monday to still be red. I don't think anything will miraculously change, right? But then what most traders do, going back to my point before I got scatterbrained, is that most traders will just look at a chart as a technical variable and say, well, that is my system. They will repeat what happens on a Monday the same way that they would repeat what happens on a Thursday, and they treat it the same. They look at both charts and they go, well, this is as good as that because it's at this level, it's doing that. It did the same on Monday, it did the same on Thursday. Okay, great, setup's the same. But it's absolutely not. There's so many things that you need to take on, so much information that you can dive into. Oh, of course you can ask a question, dude. Shoot. I've just realised I've gone down a rabbit hole, so I apologise for that. I tend to do that anyway. I tend to ramble on. This is a futures account. I'm working for allocation direct. Will it be Forex based or futures? What do you mean by that? The direct permanent allocation. So the permanent allocation, I mean, it won't really make any difference to you. All of the trades are taken based on CFD contracts because they go through our broker, regardless of whether you trade in futures or FX. But it won't make a difference to you now anyway. The 100K allocation, you won't ever see that. Like it doesn't get deposited to your MetaTrader or anything. So it might just sit up here saying you've got 130K under allocation. In fact, I don't know if it does. I've seen it do it for somebody, but they're not for somebody else. So it's weird. Maybe, but you can see it through your allocations tab anyway. But it won't make any difference to you whether it's FX based or futures based. Because so I can just trading on MT5, no difference. Yeah, 100%. Like you will only ever trade your account that you have now on MetaTrader 5. You won't ever trade anything different. That's why we only offer certain futures contracts, because we then have to take it as a CFD for investors, because we can't take investors' capital into the futures market. So let's take a look at this. Trades, 527 trades, 71% long exposure, which kind of makes sense considering the past couple of months price action and the fact that you're trading predominantly the NQ. So the NQ is your highest volume traded asset. I would expect you to be long more than you're short. And vice versa. If you're in a bear market, I would expect you to be short more than we're long. Daily trade frequency, 11.71. Super frequent, especially for a manual trader, with a 54% win rate. What's interesting with that is you've got a positive win rate and you've got a payoff ratio of 1.46, which is fantastic. So you're attacking it from both angles. The payoff ratio, for anybody who's unaware, just basically is another way of saying risk to reward. So your average risk to reward is 1.46 or 1.46R, but you're also winning 54% of your trades. Now, if you shove that in a a probabilities calculator and said, calculate this over the next 5-10 years, with those statistics, you would make money hand over fist, basically, because you're positive on both ends. You've got positive risk to reward and you've got positive win rate. So great work on that. Hence why you've got a high profit factor of 1.75. Generally, anything above 1.5 is considered good. Anything above 2 is considered like institutional grade from a profit factor perspective. Average winning trade 0.06, average losing trade 0.04, hence why you've got positive payoff ratio. Average losing trade is 8 hours and 53 minutes. And interestingly, your average winning trade is 2 days, 7 hours and 31 minutes. So almost 2 days longer, or sorry, you hold your winning trades for almost 2 days longer than you hold your losing trades, giving you a positive duration ratio of 6.24, which you might be wondering, why does that matter? The reason that matters is because it shows us that you know when to cut your losing trades and that you don't hold on to losing trades. So just by looking at this, I already know that there's a high chance when I look at your excursion chart and your duration versus profit, which is the two next charts that we're going to look at, I already know that they're going to look good, or at least there's a high chance that they're going to look good. So if we take a look at your duration versus profit, I mean, this is clean, right? So again, going back to expected value, this is basically breaking down your expected value based on how long you're in the market. So based on how long you're in the market, how many pips do you take on average on your losing trades and your winning trades? Now, for scalpers, what you find is it's usually pretty congested down the bottom, because generally the most of their trades, they're in the market for a very short period of time, and that's where they'll make the most amount of their money. Now, as a scalper, your edge is very, very limited, right? So a scalper's not going to be wanting to hold a trade for 4 hours, because it's probably going to be invalidated by that point. So you'll probably find that the longer they're in a trade, the lower their expected value is. You'll find with a swing trader or somebody who holds trades for a longer period of time like yourself, your expected value will generally get higher the longer you're in a trade, which is clear here. I'm not going to give you all the examples of all the trades like I usually do, because you have a clear example here. So you haven't lost a trade after you've been in it for 2 days and 16 hours. So you can see the duration. It might be a little bit small for you guys watching. If I just zoom in, you can see these squares here is between any trades that were between 2 days and 16 hours and 5 days and 8 hours. Then up to 10 days, then up to 21 days. Now you can see at that point, you've not lost a single trade after being in the market for 2.5 days, basically. Now, again, what that tells me is that when you're in a winning trade, you know how to run it and you know how to cut losing trades, right? You have 100% expected value after being in the market for 2 days and 16 hours. Again, it's difficult to say because you haven't got any losing trades. So as soon as you have one, that 100% expected value goes, and it'll be more like 90 something percent. And you don't really have enough data as of yet to kind of say that with confidence. However, it's very, very, very clear. The longer you are in the market, the higher expected value you have and the higher chance you have of winning that trade. So I would say you have a bit of a danger zone down here. And again, the numbers back it up. So if we look at all of these trades, I'm not going to count them all. There's 13, 2, 9, 2, 1, 1, 1, 3. So there's a lot of trades that you've taken that you've held that long. 100% expected value. You haven't lost a single one. Now, if we look at this variable, which has been in the market for under 30 minutes, if we look at how many trades you've won, 61, 62, 63. So you've won 63 trades being in the market under 30 minutes. However, you've lost 1, 4, 112, 116. So you've lost maybe not over double. But your expected value or your win rate at that point is like 30%. So your expected value is way, way, way lower. Does that make sense? I feel like I was rambling then, but I'm hoping you're following what I mean. But what I mean by this is that you have a little bit of a danger zone. So you know, in that first 30 minutes of being in the market, that's where you identify the majority of your losers. That's where you have the highest chance of taking a losing position. After 30 minutes, you take a breather and you go, okay, now let's take a look. So you're pretty much 1 for 1 there. 26 trades on the losing side, 27, 28 trades on the winning side. So slight positive expected value. So you go, okay, I've gone from 30% win rate to a 50% win rate just because we've ticked over 30 minutes. Cool, I can breathe a bit. The longer you get in the trade, the more winning trades you take, the less losers that you take. All of a sudden, your win rate starts going up. You're in the trade for 2 days, 16 hours, and you go, okay, yeah, let's run this to the moon. Whew. Now, maximum positive and negative excursion per position. I know this is favorable and adverse. So if I use those terms interchangeably, I apologize, but I mean the same thing. You have quite an inconsistent excursion chart. I'll be completely honest. And I'm not usually a fan of that just because I like to see consistency amongst all positions. Let's see what THA looks like for comparison. I mean, it's fairly consistent, but in fact, we'll take a look at mine. I think mine, because mine will be more zoomed in because there's less trades. So what I like to see on the red side, we can't really tell with yours just because of how zoomed out it is, because of how many trades that you've taken. I like to see the maximum adverse excursion pretty much, you know, be all across the same line. I know the perfect Darwin. Darwin, Colin. TVTA. You'll understand exactly what I mean with this. The best excursion chart I've ever seen. Now, you might look at that and go, well, he has a risk to reward of 1.5 or 2. But what I'm seeing when I see this is pretty much every trade that loses the same amount. Every trade that wins the same amount. Showing that the trader is doing the same thing day in, day out, regardless of P&L. They're trading the market. They're setting stops, setting targets, letting the market go to them, which, you know, not everybody likes to do. Some people like active management, and that's fair. But what I'm saying is your goal with this is to keep it as consistent as you possibly can. Now, the issue with the way you trade and that chart is that you're pyramiding into trades. So, of course, if you pyramid into a trade and it, like, for example, here, you might have got into this NQ position quite a few times and then had to close it at a loss because it just kept moving against you. However, you might have done the same here on this NQ trade, and then it ended up moving in your direction. So it's difficult to keep this as consistent as Colin does on TVTA, for example, because he's a FIFO trader. You know, he gets in one trade, closes it, gets in the next trade and closes it. I did say that I thought your excursion chart was going to be picture perfect, but I didn't take into account the fact that you're getting in so much and scaling into so many positions. So it is difficult to have sort of a clean chart from that perspective, but it's still fantastic. You know, all your green candles, all the outline green candles are generally bigger than all the outline red candles, which generally means, again, which I already know this by your duration versus profit chart, is that you can run trades very well. You run trades far better than, you run your winners far better than you run your losers, basically. You don't let your losers run against you too much, but you let your winners go on and do all the heavy lifting. Now, I don't want to sound like I'm pissing on your chips. And this is going to be the last metric that we take a look at today. I usually go through Darwinex.com as well, but we've run out of time because of the section at the start of the session. But we are going to end on a little bit of a negative, which is a shame because you've got a great start to your record. The only thing that I've noticed, which is right now, is that your value at risk is especially high. 70% VAR is really, really, really high. What we've seen over the past 13 years of Darwinex being around is generally any trader that has a 30% VAR or higher generally blows up at some point. When I say blow up, I don't mean gets margin called and loses 100% of their account, but I just mean either that or goes through a significant drawdown and loses a huge chunk, of their account to the point where it's very difficult to come back from. Let's say you lost 50% of your account, you then have to make 100% of your account just to get back to break even. Now, what can you do as a trader here? I personally would work on bringing this down over time, slowly. I am presuming that you trade with a fairly sizable contracts on a trade by trade basis. In fact, I would guess that you've probably doubled your Signal account at this point, or if you haven't doubled it, you're probably damn close, right? I'd presume maybe you're at 60, 70k profit. I would start dropping your contract size slowly. If you're trading 10 contracts, trade 9. Next month, trade 8. Next month, trade 7. Next month, trade 6. At least to get down to 30% VAR. Yes, over 10 years, been working on that and saw that with you guys as well. So it's accurate. Been working with you guys that and you guys specific. I'm presuming you're talking about value at risk. But yeah, I mean, it's a shame because your strategy, the margin. Okay. Your strategy works and the value at risk isn't a negative thing. Like, it's not to say that it's a bad thing. It is literally just the size that you're taking. Your value at risk is based on 4 different factors: the assets that you trade and their volatility, how many trades you take, the average trade duration, and your position sizing. Now, you don't trade crazy volatile assets. They're fairly volatile, but nothing wild. You trade a lot and you hold trades for a long period of time. So you're kind of up against it, right? But they all pale in comparison to your position sizing. That is the one thing that will rocket your value at risk or bring your value at risk right down. I wouldn't want you to start changing anything about your strategy just yet. Again, 6 to 9 months maybe data before you start making any changes. But like I say, if you stop trading certain assets, your value at risk would come down because you're trading less volatile assets. If you stop taking as many trades, again, your value at risk would come down. If you stopped holding trades for as long, it would come down. But that would mean changing the way you approach the market, and I don't want that. So the only variable that you really have left at this point is your position sizing, which is kind of the key thing, right? Because you could be trading the lowest volatility asset, you could be taking it once a year, you could be holding that trade for 10 minutes. On paper, you're like the least risky person in the world. But if you're trading that with 1,000 contracts, of course, you're going to have a significantly high value at risk. On the flip side to that, if you're trading high volatility asset like, Bitcoin or Ethereum, for example, you're taking 5,000 trades a day and you're holding them all for 10 years, like, your strategy significant in risk. I'm about to sneeze. Bless me. But if you're doing it all with a micro lot, like, you'll bring your risk exposure right down because you're only doing it with tiny size. So I would say try and play around with it. Set yourself like a 3-month goal to go, I want my VAR to come down from 70% to 30%, and slowly just bring your position sizing down. The reason I say do it slowly is because the value at risk works in tandem with your risk multiplier. And therefore, if you drop your value at risk straight away, your risk multiplier is going to fly up and your Darwin might see some volatility. The slower you do it, the easier your Darwin will adapt to the new change in position sizing. And with that, guys, we're going to bring it to the end of the session. If you have any questions based on anything that we've spoken about, feel free to put it in the chat now before we end the session, and I'm happy to answer anything. But if you think of any questions after the session, feel free to direct message me on Discord. Discord, for the guys not watching this session on Discord, Discord is the best place to come for access to myself, the team, to get access to the community, to be able to ask questions on a daily basis. We have kind of like a little support unit in there, from community members. So if you come in there and you ask a question, half the time before I even get there to answer the question, that some of the community members who I wholeheartedly trust with their knowledge and their experience, they get and answer all the questions for me anyway. So it's a great place to be if you need help or you just want to be around other traders with the same goals. Ohm says, thank you for your insight. You are spot on. I was working on that with the Forex, so thank you for the clarity. It helps me. Perfect, dude. I really hope that this has been beneficial for you and everybody watching. Like I say, if you have any questions after the session, feel free to direct message me on Discord. And if you want me to take a look at your Darwin, you don't have to wait for these sessions. I can try and find some time during the week if you want me to take a look, and I can either record a short video or go over and write some notes about your trading performance and send it across to you whenever I have some time. So always feel free to direct message me. Or I can even jump on a call. I don't mind. But anyway, I've started to ramble, and I know when I start to ramble, that's my cue to call it a session. So guys, have a fantastic rest of your day, and we'll be back tomorrow at 4 p.m. UK time for the Darwin explanation session. Peace out, guys. Catch you all later.